So we now move to the exchange traded fund, market crash, and the flash crash. So the flash crash was the last of the big crash that happened, and the whole idea here was that the market crashed for a very short period of time and it returned into its normal working. So it happened on May 6th, and it was the first time actually some kind of a phenomenon like that happened. And exchange traded products exhibited extreme price disruption in a short period of time before regaining normalcy. And several theories, tested and untested, have been extended to explain the possible triggers for this event. And what I'll talk about here is some of the impact of order flows, code fragmentation on maximum drawdown, that is extreme price fluctuation between 1:30 and 4 p.m. on the flash crash day. The empirical results show that the exchange where the assets are listed, market capitalization and intercap sweep orders in general associated with increase in fragmentation. In turn, the maximum drawdown of May 6 is a positive function of market fragmentation, that is holding all other factors constant. Fragmented issues experience higher maximum drawdown compared to less fragmented issues. Both the code and volume fragmentation explain the variance in the maximum drawdown, and quote and volume fragmentation, but they are distinct and capture different underlying economic dimensions. Let's try to delve into. So first let's look into the chronology and possible triggers of the flash crash. So this is an event on May 6, 2010, and the US equity market saw the most severe intraday turbulence and chaotic price swings ever. The Dow Jones declined nearly 1000 points in 5 minutes and regained 600 points within another 20 minutes. The biggest intraday decline and the second largest total point swing in the Dow Jones history. And this day is remembered as the 2010 flash crash or May 6th flash crash. The market opened among worries of European sovereign debt crisis, and it exhibited turbulent volatilities and liquidity. Against this background, at 2:32, a large fundamental trader concerned with the potential decline in equity position placed a sell order of 7,500 E-mini S&P and 500 future contract, which valued nearly 4.1 billion. The trader used the program trading algorithm to execute this hedging strategy, targeting an execution rate of a certain percent of the previous minute, with no consideration of time or price. Within minutes of execution, this unusually large trade, high frequency trader also started selling their long future position. The next buyer also quickly sold the position. This selling and buying and selling increased the volume and exerted continuously downward pressure on E-mini future contract. The future contract lost 3% of its value between 241 and 244. At the same time, arbitrator who bought long position E-S&P started selling the E-S&P exchange traded fund for hedging position. Now S&P 500 ETF lost 3% of its value in minutes. Facing increasingly erratic and huge price and volumes from future to equity market, many high frequency traders quit the equity market, further squeezing the liquidity. Internalizer in turn started routing sell orders to public equity, putting further downward pressure. Other traders and firms also intensified their selling efforts in the environment of dwindling liquidity and declining prices, produced a finally crash of 9%. In 5 minutes. At 2:45, the Chicago Mercantile Exchange paused the trading of S&P for a few seconds, giving an opportunity to high frequency traders to reevaluate and rethink the overall market condition, examine their trading strategy. When trading reopened, the buy interest re-emerged and selling price went down. Prices in both future and equity market took an upward move. Within minutes, prices began stabilize and reflecting the fundamental consensus value, putting flash crash on the pages of the history. Following academician practitioner to evaluate this cause and effect and find possible solutions for dealing with future potential crisis. So the whole idea here is that somebody was selling, and this thing caused many people to behave in a particular way, and these people are high frequency traders, the arbitragers, the person who want to internalize sub trades, and who in other case would execute these trades internal. Now internalization is trading trades in the same uh, prime banker or dealer banker, and not going to the market. And this is done for two reasons. It is done for a price that is consensus to both parties, and it is also done for a price to save the price of the brokerage. So for those reasons we prefer internalization. So this thing happened very quickly, and due to all these reasons the market fell down. Let's look at possible triggers. Now immediately after the crash, many speculating theories were exerted to identify the cause of the crash. For example, an order which is entered incorrectly, a major trading market experienced a software glitch, but not at the least there was well planned and well executed conspiracy to severely damage US financial system. Now it's also interesting to see that ETPs include exchange traded fund, exchange traded notes, and levered ETF. ETPs contribute nearly 40% of volume to overall trading in the United States. What's an ETF? I made a video on the quant ETF, you can check that out. So given the severe impact on ETF during the market crash, some believe that ETF were culprits. According to ETF critic, pricing structure and trading of ETF are major source of disruption in market activity. And some empirical study concluded that the volatility spillover from future to equity during the flash crash was heavily caused by ETPs. Other studies arrived at similar conclusions, suggesting that the ETP's pricing mechanism, that is, there may be disparity of price of ETP and underlying asset NAV, and the rapid proliferation of ETP produced a systematic risk to financial system. It is possible that ETPs could generate much more severe crisis in the future. This is in itself an exchange traded fund, a fund that have a passive strategy, and they would buy and sell futures or play around with them each time, and they rebalances at a particular time. So this is something that they believe caused the trigger. Then we have the high frequency trading. High frequency trading refers to routing market, and with the minimum reaction time, and high frequency is exhibiting a significant upward trend, and it consists of nearly 70% of dollar trading activity in US market. High frequency traded for using code stuffing tactics to gain competitive edge. They post a quote and immediately cancel it. According to one estimate, order cancellation is in the range of 90%. The purpose of bombarding the market was to scoop the other traders, including less sophisticated, busy analyzing and computing data, so that they may do nothing but handle raw data traffic. During massive quote stuffing period, fewer trades take place, and HFT benefits of such trade. A low quote stuffing period, a high number of trades were executed, but HFT were usually out of the trading activity because such a trade are for less sophisticated investors. So quote stuffing creates a two-tier market, one for HFT and other for less sophisticated investor. Within the family of HFT, the winners are the one who have more sophisticated computational techniques and network system. Also, it should be noted that quote stuffing activity has apparently no linkage to trading or market events. Empirical studies offer different results of HFT and its impact on market quality. On one hand, studies show that intense quote stuffing is associated with increased volatility. However, lower liquidity, high transaction cost, and impairment of price discovery. So intense quote stuffing is considered bad. Other studies show that it's a mixed result. So HFT generates efficient pricing but at the cost of widening spread. Another study sets HFT free from the allegation of being triggering the flash crash, what holds is responsible for a decline in market liquidity. So few theories, this quote stuffing, and another theory is that they suddenly withdrew from it, and since they were the liquidity givers, the liquidity fell down and the market fell down. So that's again another possible trigger that's being pointed here. Now possible trigger 4 is the toxic order and intermarket sweep orders. So this is again another theory that is being linked, and let's check out what that means. So order flow toxicity, aggressive order behavior can disrupt liquidity, causing destabilization in the market. Order flow toxicity associated with an increase in volatility that informed investor hedge funds adversely select the uninformed investor, market maker. The market maker are forced out of the market, liquidity squeezes, and the market order become more toxic, feeding up continuous loop, put downward pressure on liquidity. Empirical study finds strong evidence of an increase in toxic order flow and resulting decline in market liquidity 1 hour before the flash crash. Internal sweep orders, also known as liquidity demanding orders, are used by aggressive HFT to sweep the entire book, taking away liquidity. An empirical study found that significant increase in ISO and TQV from the bid-ask market during the flash crash, considering the ISO may have been triggered the flash crash. So these are some issues. Now, whatever things that caused it, it's still an area of research, but what we can say conclusively is that there are strong indications that it is due to high frequency trading, it is due to the exchange trading FUD, and it is due to some other reasons like that. So when we move ahead and we have the study data analysis, where we study the data set, measurement felt, multiple regression model used in the study, calculate the maximum drawdown and concentration ratio and volume, and quote the Herfindahl index. So academic studies have examined whether market drawdown of market 6 2010, which can also be termed as market discount, exchange price movement volatility, is associated with fragmentation order flow, which is the split of order flow in various trading venues. To evaluate this question, author utilized multiple regression techniques. The details of set, measuring flags, and multiple is used are discussed below. So there is a data set, and the academic study analyzes topic uses exchange traded fund equity process classified under exchange and equity class. So they are the equity group and they are the exchanges. So the sample originally consisted 6,000 equity instruments, for which sample trading data of Bloomberg available for 21 days and 20 days prior to the flash crash. This is shown. This is the study uses data from 7th April to 5th May 2010 and the flash day order. 51 stocks were excluded due to occurrence of corporate events, leaving a relatively clean sample of 6,173. So variable measurement. To examine the impact of flash crash on securities, a variable named drawdown used as dependent variable on multiple regression framework was constructed between a price change from 1:30 to 4 p.m. The drawdown variable is 1 minus the ratio of the lowest price during the interval to the highest price. So they created this drawdown variable, that's a continuously variable, and lowest price and the highest price, and 1 minus that, and they gave this name a DD, which is the drawdown. Now the equity instrument affected the most will have higher DD and vice versa. So this is just created to find out the equity effect on the on them during this flash crash. To isolate the impact of fragmentation or drawdown, an assortment of variables were used as control variables which have potential impact on drawdown. That is, the purpose of multi-factor model was to examine the impact of fragmentation of order flow on the drawdown on flash crash day, holding all other constant. So intraday data was collected by a number of equity instruments and close-ended fund, ADR, common stock, size of the firm, and the hypothetical example of drawdown to compare contrast how many securities were impacted during the flash crash was like intraday low price, intraday high price, and the drawdown. So it was like finding out which securities were highly affected and which were not highly affected. So getting an idea of which security was highly affected could help us to get some hints. So concentration ratio is the next term that we looked at, which is the simplest measure of market concentration. So it is the measuring the percent of fragmented share for a given equity in the n highest market share. So concentration ratio is defined as percent of share of volume in the n minus marketplaces. For example, stock ABC, the market share of 3 largest market venue is volume traded and market 1, 2, 3. So the last concentration represents the combined volume of shares largest trading center. So we are also looking at where they were traded more, because there are few things here. There are different I think around 17 exchanges and 50 dark pools, although I don't think they have talked about dark pools here, but to understand where the trading was happening would actually help us to find out what's going on. So the VHI, which is known as volume Herfindahl index, is a broad measure of competition, and it's going to help us major competition as it's gone beyond the largest share centers. There is no hard and fast rule of the market of venues to be included. In some areas, the index include up to 15 firms. So this was something that was studied in the economics, if you remembered, where we were looking at market share of market I. So we are calculating a same market index. Then we have the quote Herfindahl index, where the quote fragmentation reflect the competition from order flow through quotes among HFT and other aggressive trader. So we were doing all this to find out in which market there was more quotes and the best quotes and what was happening. Now the study here, just understand the things that we want to study, that is the quotes, where the quotes are cited. We also want to study the markets where these are priced, and also the fragmentation of the markets, like which could hold all of the activity and things like that. So quote fragmentation reflects competition for order flow through quotes among HFT and other aggressive traders who could diminish liquidity on the market. As a result, earlier quote stuffing, ISO and venue toxicity are example of aggressive trading activities that could rapidly shift liquidity. The QHI captures such behavior. So we are all trying to capture suspicious behavior by looking at all of these terms. So percent of quote, backstop, market venue, and these are the things. So let's look at flags. Now ISO are identified by condition code F, also known as flag, in the dataset. Institutional investor and market frequency use ISO to take away all available liquidity in the given market. ISO are entered as limit order as they don't fall under the domain of order protection rule. That is, trader can sweep away the entire liquidity at the given trade venue even if the market venues offer superior quotes. So other flag used in the transaction quote level are exchange and ETP, that is exchange traded fund. So then we had this entire study being done, and let's move ahead. So I understand that things have become tricky, but I'll try to simplify it down. Just understand that we are looking at the reasons of why this crash happened, and we are gathering some terms that's going to help us. So let's move to multiple regression model. So market fragmentation determining model. So a study of the flash crash using logistic regression describe that VHD or QHD is a multiple linear equation between NISE, market cap, intraday volatility, ISO and ETP. So we are trying to calculate the volume and quote, Herfindahl index, and concentration. So the purpose of logistic regression is to determine the stock specific and other associated variation in volume and quote concentration for exchange traded security. The model utilizes full usable sample of 6713 exchange traded fund. NISE factor is a dummy variable. Its value, if it's traded NYC, is 1, otherwise it's 0. Lot of market capitalization is another explanatory variable. Average volatility of asset estimated of standard deviation of 5 minutes interval between 130 to 4. And to draw down what was the reason of the stocks being traded at different model. Now we have the drawdown regression model. A multivariate cross-sectional regression employing a full usable sample is performed to explore one more question. Controlling for stock-specific factor which could have contributed to pricing on flash wave or traded asset to higher fragmentation in prior days became more vulnerable to extreme price fluctuation on the flash crash day is a question that we want to ask. That is, this fragmentation stock in previous day exhibit larger maximum drawdown on flash crash day holding all other constant. So to investigate this important question, we again regressed and find out what is the maximum drawdown, and is it related to the Herfindahl index, volume, the inverse of opening price, ISO and ETP, and we did all this. So let's quickly summarize all what we have been trying to do. So the purpose of statistics that we have summarized is to present a comparison of market microstructure variables such as concentration ratio, Herfindahl index, intra-market sweep orders between pre-crash period and the day when the crash actually happened. And the sample consists of 6,000 exchange traded products, around 5,205 equity instruments, and around 968 exchange traded products. So the key insight obtained from the descriptive statistics is as follows. Fragmentation is significantly higher on May 6th than the previous 20 days. The concentration ratio exhibit a general decline with withdrawal flash crash day, providing the main hypothesis of study that fragmented stocks are vulnerable to the flash crash day extreme price movement. However, the relationship is not monotonic. The use of aggressive quote captured by high frequency traders of intra-market sweep orders significantly increase, and in particular ETP sample compared to non-ETP sample. For example, the frequency of ISO increased from 0.28 to 0.36, 28% increase of non-ETP sample, whereas it increased again for the ETP sample also. So another key issue is the fact that ETP were affected more severely compared to non-ETP on flash crash day. For example, the average drawdown for equity issue is 0.08, whereas average drawdown for ETP is 0.24. Also, the concentration ratio is much fragmented for ETP sample, and the concentration for VHI for the ETP sample declined from 0.56 to 0.45. And continuing ahead, as the volume and the market cap increase, the concentration in VHI decline, indicating that more liquid stocks are subject to greater fragmentation. The QHI declines, but in relatively smaller magnitude, reflecting different underlying drivers to quote fragmentation. The frequency of ISO generally monotonic with increase in liquidity decline, that is frequency traders use aggressive quote order or more liquid stocks, which produces fragmentation. Liquidity and maximum drawdown or flash crash day exhibit a positive monotonic relation but to modest increase in volatility. At high level of volatility, the relationship is still positive but not monotonic. So this was a study that had some conclusion on what was happening on that day. And let's look at stock fragmentation variation. So using intraday ticker or tag data from Jan 3 1994 to September 12 2001 for all US equities, VHI is calculated for each stock. To develop an overall market concentration, a daily average of Herfindahl index based on individual value is developed. The time series pattern showed that average VHI is fairly stable and constant. However, there is continued decline in concentration index beginning second quarter of 2003. Several key market structure development include introduction of decimation in 2001 and emergence of dark pool and electronic computer environment, increased internalization of order flow by broker, increase in high frequency trading intensified the market value competition. For example, 1% quotes versus 1/8 or 1/16 decimation increases the trading center competition. Also, high frequency trader preferred venues of trading are ECN or the dark pools and not the main exchanges, thus that rate further fragments the order flow. The VHI average value of September 2011 was 0.31, an impressive level and much lower at the start of the time series 18 years ago. The gigantic increase in order flow fragmentation, particularly without adequate intermarket linkage, is alarming. Any liquidity, order flow or other shock can produce huge systematic stress. To examine concentration ratio on flash crash day by using VHI and QHI for May 16 and May 5 are estimated for relative 5-year corresponding to interval. Based on the stock average, concentration ratio is developed, and the 5-minute moving average for relative quote of Herfindahl index shows a sharp decline at the time of the crash. It is the lowest value relative to previous day, approximately 10% level. This suggests that fragmentation increased according market center in the lane afternoon when exchange traded competition specified. On the other hand, VHI shows a sharp increase in concentration at the time of the flash crash. During the time period, NLSI hybrid market was fully operative and intermarket linkages were totally ineffective. The divergent trends on flash crash, they reinforces the view that volume and growth fragmentation are discussed. They capture different economic phenomena. The market share trend revealed that each equity market by and large was experiencing stable and consistent share. However, the situation changed quickly at the time of the crash, and interlinkage became effective and a sharp decline in its fine. After some time, later part of the market share took a downturn and normalcy of share become declining. So summary of fragmentation regression result. Now we have volume HD and quote HD. So the NYSE indicator variable has a negative and statistically significant coefficient, showing that the stock listings are more fragmented both in volume and quotes as compared to stock in other market values. Large cap issue exhibit higher volume fragmentation but not quote fragmentation. These results suggest that there may be determinants other than size which explains variation in price or quote competition. Underlying strategy to enhance profitability quotes meant to be too complex. Volatility is not a significant variable in either regression. The ISO variable is significant and positively associated. Results are consistent with early discussion SFT using aggressive quote and volume strategic sweep or availability in the limit order book. The exchange traded product variably is not significant in either regression. So maximum drawdown regression result, and the whole idea here is to understand what was happening at those times. So maximum drawdown regression results show a positive association between fragmentation and maximum drawdown. When QHI is introduced using the most recent data, the VHI becomes insignificant. However, QHI is still significant, indicating each index captures different dimension. The volume and liquidity variable is significant only in regression utilizing 1-day period data. Standard deviation is inverse opening prices and intra-market sweep are insignificant. And holding all other factor constants, the exchange traded product variable is positively associated with the maximum drawdown. The ETP was significantly impacted by extreme price movement on the flash crash day. So this was the whole story of the flash crash. I know this is a little of research level topic, so it's quite tough to understand and gather all those things in a very simple way. So this was what I understand that this was tricky. I'll try to get this done in a simpler way and break this down into what happened on the flash crash day in some other videos. Thank you for listening, and I hope you added something to your knowledge base.